Hello and good afternoon, everybody. It's Casino Capital here. It's afternoon, just after lunch in the UK. Just wanted to record this quick video today discussing the concepts of value and momentum-based strategies when investing. So let's dive in. Let me share this screen. Here we go. So I released a tweet this morning discussing quantas. This is going to be a really good case example to go through here. So this tweet that I was referring to was from back in September the 12th, so over a month ago. One of the momentum strategies that I use, one of the signals actually flashed at this point. I've got a better screenshot of it here. So you can see price was, on the day it was about 108, but the price was hovering between 95 and 105, something like that. And obviously price has gone over double that this morning. So I just wanted to break that down, exactly how to think of this and how you can potentially incorporate some of these strategies yourself. Obviously nothing here is financial advice. I'm just sharing some of my thoughts on the market and how I like to approach it. So the two concepts are value investing versus momentum-based investing. So let's just look at a blank chart, or fairly blank chart of quant first, so you can see the whole of the price action on the log chart here. Before we go into momentum investing, let's talk value investing. So value investing is essentially buying assets when they're as cheap as possible. So the point of maximal value here in the last cycle is the point of minimum bullish momentum, and the point of maximum bullish momentum is the point of minimal value. So for value investing, it's a case of trying to buy things as cheap as possible and then sell them when things start to become more expensive up here. Okay, so that's just in a nutshell value investing. So I like to use both strategies. I have separate accounts for each strategy, which makes it easier to define exactly how you're playing it. So for example, in this cycle here, a value-based approach, you're looking to just basically dollar cost average as price comes lower and lower. And you want to have a price range in mind. I mean, one way is just using percentages of the drawdown. So if you look back in this cycle, you can see that it was roughly about a 90% drawdown from top to bottom. So it's actually very similar in this cycle. So down at the bottom, let's get it. So yeah, pretty much exactly the same. So around 90%. So, you know, we had this key support here, price retested it as resistance, and then price shat the bed. In this period here, coming all the way down, you know you're approaching that 90% drawdown. This is very tempting from a value proposition. And you don't want to just use all your coins, all your dollars or stable coins here, because obviously price can keep coming lower. And it still may do, no one knows. So you always want to have some dry powder in either momentum or value investing, but, you know, particularly value investing, you know, you're not looking to make a quick buck. You're trying to buy things as they're cheap and be patient and wait. And then as price appreciates, it starts to get more expensive. Then you can start to take profits and gain your cash position back. So let's move on to momentum investing here. So we're going to do this on a daily format first, then we're going to go on to a weekly second. So as we said, the momentum strategies, you're not going to get the same maximal returns as you would if you executed a value strategy perfectly. If you bought the bottom here and sell the top there, which obviously is fairly unrealistic, but let's say you did that, that's clearly the highest returns you can get. With momentum investing, you're willing to sacrifice some of the initial gains and to sacrifice selling the top up here as a way to manage your risk and use a defined strategy in order to when to buy and when to sell. So you're not going to get the same, you know, returns, although I'll show you here, you can still do very well. So initially what we want to look at is using the moving averages. So as I've said before on Twitter, on the daily, I like to use the 200-day, the 100-day and the 50. You can either use the MAs or the EMA, slightly different. Sometimes use a combination of both, but they're the numbers I like to use. And essentially, first, if we start with the 200-day, so when I released that tweet, I knew things were getting interesting because what you first want to do is look at the gradient of the higher moving averages. So the 200 day is quite a high moving average. So obviously in the downturn, it's coming down and then it starts to flatten. When price can get back above this and the moving averages is flattened, that's obviously quite a good sign. If it can get above and hold it as support, even better. So this is when I started to get interested in quant from a momentum point of view. So it's important to define those distinctions, because obviously from a value point of view down here is much better, but for momentum, this is one of the first ways I knew we were getting some strong momentum. The moving average is flattening. We got above it, we came back, tested it as support, held it, and then bounced above. And that there was a really interesting signal. Obviously since then, prices flew. And it was the same back here, price flew. So what we then want to do is just layer on the other moving averages and talk you through that. So let's put on the 100-day and the 50-day. So this is something that I've also discussed in what I call the bullish EMA formation. So for the daily, what that means is the lowest moving average should be on top and the highest moving average should be on the bottom. So we've got the 50-day on top, we've got the 100-day in the middle and the 200 on the bottom. And that's what I call the bullish formation. So you can see throughout this whole bull market, that structural integrity maintained up until here, and it formed just here. So really, when price gets above the moving averages, comes back to retest, and you've got that bullish formation of the EMAs, that's, in my opinion, with one of the strategies I employ, that's a good time to buy. Now, obviously, the inverse of that, the time to sell, is when price loses those moving averages, which it did back here. You get a cross of the EMA, so the formation is lost, and the price does a bearish retest of the moving averages. So that, or back up here, that would have been your sort of signal to get out. So it's not the top, it's not the bottom, but you're capturing a big chunk of the move and you've defined your risk, which is really important. And obviously there's lots of other ways to do this. This isn't the only way. You can use other indicators, you can do support resistance, you can use fibs. There's loads of ways you can do it. I just wanted to break down the, one moving average approach for momentum. So if we just take the numbers here, what you could have achieved. So back down here, you're looking at around $5 in the sell. When we crossed and retested up here, it was about 220. So it's over 50x, which, is pretty incredible, to be fair. You can't really get those returns in many other places. So we'll go on to the weekly in a second. I mean, it's important to note, as I've been saying before we do that, is that you can see these moving averages have flipped in our favor for the bulls here. So we've got the bullish formation. It's only just started. People are getting a bit carried away because obviously the price has gone berserk, as it did, say, just at this point here or this point here. But what will tend to happen is, if we are bullish, it will have to come back and retest these moving averages. And this is what I try to make people aware of on Twitter, who are getting a bit carried away, is if you're bullish and you want to add to your positions, just wait for the pullbacks. It will come. It's not going to keep going vertical forever. And if it does go vertical, then generally it's a sign that it's unsustainable and it will just completely fall after. So something to to be aware of, and that's how I would approach this anyway. No point chasing prices, it's soaring like that. You always want to be patient and wait. So let's go on to the weekly next. So let's get rid of these. So again, what we're going to do, so for the weekly, what I like to use is the 8-week, the 21-week, and the 50-week. Okay, so let's just start with the 50-week, so the higher moving average first. And again, as it flattens and price gets above it, as it flattens, just starts to uptick, that's your sort of signal. So it's got above the highest moving average, it's come to retest, the moving average is flattened, and it's just started to increase. That's the point where the bullish momentum is just starting. It's saying we've got the same here. So we've got above, just underneath, bit of a beach ball underwater, and then it's flew. We see the moving average now is ticking up. So it's not just as simple as that. We want to layer on the other moving averages. So let's put the 21 on next, and then the 8-week. So again, you want the lowest moving average, the 8, to be on top. Then you want to have the 21 in the middle, and then the 50-week underneath. And we want to keep that same structural integrity. So you can see again in this bull market, once we flipped into that bullish formation here, you can see that structural integrity. The 8 was above the 21, was above the 50, and that held the whole time. Obviously, sometimes with these you can get fake outs and it can make it a little tricky. But just this was a really good case study of how to keep it simple. So again, we can see what flashed up today. So we can see the 8 weeks on top, and then we got the 21, the orange, cross the 50. So now what I would call the bullish formation has just formed. And again, as I said on the daily, really what we want to see is a retest of at least the 8, may even come down to the 21 or even the 50. And that's the point where you could think about adding to your positions. Obviously, once the formation is lost and we get a bearish retest, that's the time to get out. So they're the things to watch to get out. Let's just have a look at one other thing I wanted to show you. So we'll just let's get rid of these moving averages for a second. Oh, there he is, the little bugger. Right. So the other thing you can use for this is the RSI. And this tends to work on different time frames, but generally the higher the time frame, the more reliable. And what we're looking at with the RSI is anything above 50, which is the midpoint, is starting to get bullish momentum. If you're below 50, you've lost that bullish momentum. So again, this is just another way to have confidence with your moving averages or whichever other strategies you employ. So you can see back here, it worked pretty well. So that was the point where we got the moving average cross. And you can see that's where we actually got above 50 and we retested 50 pretty much on the button as support. And throughout this whole bull market, you can see the RSI was always above 50. When we lost it here, this is where the momentum obviously was clearly shifting. And then right down at the bottom is the point of minimum bullish momentum. And you could argue maximum value. So you can see in present day, back in August, we managed to get above, which is great. But then the more important things, we came back and retested it, held it again as support, very similar to here. And now we flew off. The price has definitely sort of been a bit more aggressive this cycle. You know, starting to get oversold. It will need to come back. You can see it chopped up a lot here, price chopped a lot. We will get a pullback at some point, and that's the time then to reassess. You want to reassess exactly where your moving averages are, if the bullish formation still remains, and you want to see where the RSI is as well for your momentum strategy. Obviously, if that formation is lost, if price gets underneath it and retests the moving averages as resistance, then from a momentum point of view, you want to get rid of that, cut the trade, and then, you know, keep your cash and then look to see if it regains it. If it regains it, you can always re-enter, and there's no problem doing that. Obviously, at the same time, in a separate account, you'll have your value positions where you will have bought these lower prices when you've got these crazy discounts and you've been accumulated. So you still hold these and you may have distributed some profits already. So yeah, I think that pretty much clears it up for now. Like I said, I just wanted to cover value and momentum. And I think some people on Twitter can get a bit caught up with this and telling people, oh, you know, when to buy and when to sell. And, you know, it all comes from your strategy, your time horizon, and all of those things. But I think splitting it up into value versus momentum is a good way to look at it. And hopefully you've learned something there. And if you want to ask any questions, obviously fire them away in the comments, and you can also contact me on Twitter, which will be in the description. Okay, guys, nice to catch up with you and speak to you soon. Take care.